$891 million. That's how much the United States is currently spending every single day on military operation in the Iran conflict. Not per year, not per month, per day. And that's nearly $37 million every hour quietly being added to a government balance sheet that's already carrying more than $38 trillion in national debt. And here's the part most people aren't talking about. When government spend money like this, especially on wars that were not fully budgeted, the bill eventually shows up somewhere else, sometimes through higher taxes, sometimes through higher inflation, and sometimes through higher borrowing cost that ripple through the entire economy. So the real question isn't just what's happening in the Middle East. The real question is, what does a $900 million per day war mean for the US economy, financial markets, and ultimately your money? Because while politicians debate strategy in Washington, the financial consequences are already starting to show up in oil prices, stock market, and government debt projection. And now, if you are new here, this channel focuses on breaking down the biggest economic and financial stories shaping the world, and more importantly, explaining what they actually mean for your money, your investment, and your financial future. And today we are diving into one of the most expensive development unfolding right now, the growing cost of the Iran conflict and how it's quietly adding billions of dollars to the US debt every week. So let's start with the number that's grabbing attention across policy circles. According to a detailed analysis from the Center for Strategic and International Studies, a respected Washington-based think tank, current US military operation in Iran, known as Operation Epic Fury, are costing American taxpayers approximately $891.4 million per day. Nearly $900 million every single day. Now, to put that into perspective, in just the first 100 hours of the conflict, the estimated cost already reached $3.7 billion. And here's the part that really matters. More than $3.5 billion of that spending was not budgeted in advance. That means the Pentagon is essentially burning through resources in real time, funding a massive military operation that Congress never fully planned for in the current budget cycle. So where is all this money going? A large portion is being spent on advanced missile interceptions, air strike mission, naval operation in the region, precision guided munitions, aircraft carrier deployments, and logistic and ground support. So early phases of military conflicts are often the most expensive. That's because they involve intense air campaign, high-tech weapon systems, and large-scale force mobilization. Missiles alone can cost millions of dollars per launch. For example, certain advanced interceptor missiles used to shot down incoming threats can cost $3 to $10 million each. So when you are intercepting multiple missiles a day, those costs add up incredibly fast. Experts say cost may decline slightly over time if operations shift toward cheaper munitions and if Iranian missiles launches slow down. But there's another possibility. If the conflict escalates, if the United States expand operations, or if ground forces becomes involved, those daily costs could easily climb into multiple billions per day. So why this matters for you? Now some of you watching might be thinking, okay, that sounds expensive, but how does this actually affect me? And that's a fair question, because this isn't just abstract foreign policy. This is taxpayer money. And when the government spends hundreds of millions of dollars every day on an unplanned military operation, that money doesn't simply disappear. It has to come from somewhere. In most cases, it comes from borrowing. And that borrowing gets added to the US national debt, which is already sitting at over $38 trillion. And every additional dollar borrowed today means more interest payments tomorrow. And those interest payments are funded through federal revenue, which ultimately means taxpayer dollars. And right now, interest payments on the national debt are already becoming one of the largest expenses in the federal budget. And some projections suggest that within the next decade, interest alone could rival or exceed defense spending. So when new war costs pile onto the debt, the long-term financial pressure grows even heavier. And historically, governments tend to deal with that pressure in three ways. They raise taxes, they cut spending on programs, or they borrow even more money. Each option carries real consequences for everyday Americans. Now let's break down the math so this feels more concrete. So the current US defense budget for 2026 is estimated to somewhere between $900 billion and $1 trillion annually. That already makes it the largest military budget in the world. Now add a conflict that costs nearly $890 million every single day. In just 1 month, that adds roughly $26 to $27 billion in additional spending. 3 months, that's over $80 billion. And those estimates assume the conflict stays relatively contained. Economic researchers at the Pan-Wharton budget model have analyzed similar geopolitical scenarios. Their projections suggest that a 2-month regional conflict could add somewhere between $40 billion and $95 billion in direct government cost, but the indirect economic effects could be even larger. Higher oil prices, disrupted global trade routes, market volatility, and slower economic growth. Those secondary impacts could create an additional $50 billion to $210 billion in broader economic loss. And that doesn't even include long-term interest cost on the new debt. How markets are reacting. While policymakers are debating strategy in Washington, financial markets are already reacting in real time. Whenever geopolitical conflict escalates, markets often shift into what's known as risk-off mode. Investors move away from riskier assets and towards sectors that benefit from rising commodity prices or increased defense spending. So in the early stage of the conflict, major indexes like the S&P 500 and Nasdaq experienced declines of roughly 1 to 3%. Technology stocks and consumer companies were hit particularly hard. Why? Because higher oil prices increasing operating costs and squeeze consumer spending. Airlines, cruise companies, and travel-related stocks are especially sensitive to rising fuel prices, and those sectors have already seen noticeable decline as energy costs surge. But while some sectors struggle, others are seeing significant gains. And the energy companies have been among the biggest beneficiaries so far. As geopolitical tension rise, oil prices often climb due to fears of supply disruption in the Middle East. Companies like ExxonMobil, Chevron have seen strong gains as investors anticipate higher energy profit. Energy-focused funds like the Energy Select Sector, SPDR ETF, ticker XLE, have also surged as capital flows into the sector. And defense contractors are another clear winner. Companies such as Lockheed Martin, RTX, formerly often benefit from prolonged military conflicts because increased defense spending leads to larger government contracts. And then there are the classic safe haven assets. Gold has historically performed well during periods of geopolitical uncertainty, and investors tend to move toward physical gold, gold ETFs, or gold mining stocks as protection against inflation. So what investors can do right now? Now none of this means panic, but it does mean paying attention because geopolitical events can reshape markets quickly. And here are a few practical steps investors may consider in an environment like this. So first, review your portfolio exposure. Take a look at your retirement accounts or brokerage accounts and see how heavily you are concentrated in broad equities. In some cases, adding a small tactical allocation, maybe 5 to 10%, to sectors like energy or defense can help hedge against rising geopolitical risk. Second, build a stronger cash buffer. High yield saving accounts are still offering returns around 4.5 to 5%, which makes them useful for protecting liquidity while earning interest. And having additional cash available can help cover rising living cost or unexpected tax increases without forcing you to sell long-term investment. Third, consider inflation protection. Long-term geopolitical conflicts often lead to higher government debt and persistent inflation pressures. A small allocation, perhaps 3 to 8% of our portfolio, to assets like gold, commodities, or inflation-protected securities can help preserve purchasing power. And last, evaluate your personal debt situation. If you carry high interest variable rate debt, such as credit card or adjustable rate loans, it may be worth exploring opportunities to refinance or reduce those balances before borrowing costs rise further. Now the bigger picture and the bottom line is this. Wars are incredibly expensive, and the nearly $890 million per day price tag attached to the current Iran conflict isn't just a headline. It's a financial reality that affects the broader economy. Every additional $1 billion is spent adds pressure to the national debt. That debt increases interest payments, and those interest payments eventually influence taxes, government spending priorities, and economic policy. At the same time, markets are constantly adjusting. Energy companies are benefiting from rising oil prices. Defense contractors are seeing increased demand. Safe haven assets are attracting investors looking for protection against uncertainty. Understanding these dynamics helps investors stay informed instead of reacting emotionally. At the end of the day, wars are not just fought with weapons, they are fought with money, debt, and economic power. And right now the meter is running at nearly $900 million every single day. So I'm curious what you think. Are you more concerned about rising national debt or about how geopolitical conflict could impact markets and investment? Let me know in the comments. I read them all and they help shape future videos. And as always, this video is for informational and educational purposes only and should not be considered financial advice. And thanks for watching, and I'll see you in the next one.